We started this lesson with a discussion of first versus third-party ownership. If the policy owner and the insured are the same person, it's first-party ownership, and it's third-party ownership when the owner of the contract and the insured are different. In third-party ownership, the owner controls the policy, and the insured is the person whose life is the basis for it. Don't forget about the different insurable interest requirements based on ownership. This is an important part of the process. Viatical and life settlements exist for one purpose: selling a policy for cash to a settlement company. Then, when the insured dies, the settlement company receives the death benefit. They're similar to each other, but have some important differences. For example, a viatical requires the insured to be terminally or chronically ill, and life settlement plans do not. How much life insurance a person needs is always an important consideration. Most prospective insureds think in terms of general numbers and have no idea how much they actually might need. There are different ways of determining proper coverage amounts. While the most common method is the needs approach, the human life value approach is sometimes used. Business insurance needs are an area that a lot of agents overlook, but it's a fairly big market. These policies can prevent a business from having to shut its doors after the death of an owner or key employee and should never be ignored by an agent. Retirement plans can be a part of a company's benefit program. At the same time, there are plans for employees not participating in company-sponsored programs like a 401k. Retirement plans are either tax qualified or non-qualified. Sponsored plans allow tax deductions on the part of the employer for contributions made on behalf of employees. Most of the plans also allow pre-tax contributions by the employee, and the funds grow on a tax-deferred basis. Of course, this means that when the funds are withdrawn, they'll be fully taxed. Don't forget the one side, not both theory. If you can deduct a contribution of your taxes, those dollars will be taxed later. For example, when a participant puts money into a 401k, it's done on a pre-tax basis. Since those dollars have never been taxed, they'll be taxed when withdrawn. We'll continue with a look at the characteristics of these plans, how they are viewed by the IRS, and the taxable situations associated with them. We focus on the two different types of individual retirement accounts: the traditional or regular IRA and the Roth IRA, which is primarily intended for middle-class wage earners as they have earnings maximums for contributions. We're going to look at policy loans, their effect on the death benefit, interest that may be charged, and what happens if the loan defaults. These are typically tax-free, but there is a possibility that they can be taxed if circumstances change in the policy. Finally, we're going to discuss modified endowment contracts. These are life insurance policies that are treated by the IRS as more of an investment because the policy fails a specific test mandated by the IRS. If a life insurance policy becomes a modified endowment contract, it loses many of its tax benefits.